Welcome to today's broadcast of In Conversation with Dr. Sherry Cooper. We'll be exploring the world of mortgages in Canada and why it's important to have a deep understanding of this topic. To guide us through this conversation, we're joined by Dr. Sherry Cooper. Dr. Cooper is a renowned economist, financial expert, and best-selling author with over 30 years of experience in the industry. She's also the chief economist at Dominion Lending Centres, Canada's largest mortgage company. In this episode, Dr. Cooper will provide us with valuable insights and expert analysis on the current state of the Canadian housing market, the impact of interest rates on mortgages, and the importance of working with a trusted mortgage advisor. We'll also delve into the services offered by Dominion Lending Centres and why they're an invaluable resource for anyone looking to purchase a home or invest in real estate in Canada. So whether you're a first-time home buyer, a seasoned investor, or simply interested in the world of finance, this broadcast is sure to provide you with valuable information and insights that you won't want to miss. So sit back, relax, and join us as we dive into the fascinating world of mortgages with Dr. Sherry Cooper and your host, the president of Dominion Lending Centres, Eddy Cocciollo.
Wow, this is our last ICW for 2023. This year has had its share of challenges, especially around real estate and interest rates. Most might say they're okay with looking at 2023 in the rear view mirror, but today we did see the Bank of Canada hold rates for, I think this is the fourth or fifth time in a row now. Which is what was predicted by our chief economist, Dr. Sherry Cooper. Also, we're seeing the 5-year bond rate retreat. I know that, Sherry, you're going to talk a lot about that, I'm sure. I think it dipped under 3.4% today, which is probably the first time since June. Oil's coming down. I saw that oil keeps slipping, and the stock market in October didn't look very good, but it definitely is coming back. So much to talk about, Sherry. Looking forward to hearing from you, our chief economist. But before we get to Sherry, just a reminder, if you want to ask a question, please do. We love questions. You type them out in the comment screen. I will get to them after Sherry finishes her presentation. I wanted to quickly thank our sponsors, FCT. And let's not waste any more time, Sherry. Let's talk about what's going on. And I'm pretty sure you're probably thinking the same as most people. 2023, let's get past it. Let's get into 2024.
Yeah, it has been a tough year for a lot of people, but even so, we still haven't seen a recession. And there are plenty of bears out there who have been arguing that we would already have been in recession by now. So
pretty resilient. Yeah, pretty resilient.
Absolutely. And of course, even with unemployment rising, our economy has remained resilient. So let's get going here. There's a soft landing so far anyway in the economy. We just saw the third quarter GDP number print negative at minus 1.1%. But even so, it looks like for 2023 as a whole, the growth numbers will be a full 1% positive. Now, here I'm showing you the forecast as I see it. Remember, these numbers are subject to change, even the numbers that are to the left of the forecast. We've seen revisions in those as well. In fact, for the second quarter, that number was originally a decline in economic activity, a small decline, but a decline nevertheless, and it was revised up to 1.4%. But we see here that for the third quarter, minus 1.1% has led the Bank of Canada in today's statement remarked that the excess demand is gone, the economy has slowed, and there's a good chance that we've seen sufficient tightening in monetary policy to bring inflation down further. Now, they, of course, also included the caveat, which is if they need to raise rates again, they will do so, which, of course, we know. Now, looking at this forecast, you can see that, we skipped over a bunch of things here. Okay, looking at the forecast, you can see that I am now suggesting that for the fourth quarter and the first quarter of next year, we're going to have flat growth. That means that it will not be a technical recession, 2 quarters of negative growth. And that's largely because of the boom in population growth. So, in other words, had we not seen tremendous influx of immigrants and also more temporary workers, we would well see negative print and recession. But we're not doing that. We're not getting that right now. Instead, we're likely to see modest growth, but continued growth. So this shows you that population growth has inflated economic growth and that GDP per capita would be down 2.4% year on year if we hadn't seen enormous growth in population. As well, we see that the consumer spending has slowed. So headline retail sales actually edged upward in the most recent data. That was for the month of September. But if you look at core population adjusted retail sales, there would have been a decline. I think all the economic data are suggesting the same thing. The economy in Canada, it's stronger than what normally would be expected given the tightening in monetary policy, because we are seeing such robust numbers in terms of the numbers of new workers, the numbers of new entrants to the population. The Bank of Canada, as well as Statistics Canada, suggest well over 800,000 new workers have joined the labor market over the course of the past year. That's without precedent, by the way, so that's really quite astonishing. So moving forward, credit card delinquency rates and auto loans are rising. And yet we have not seen a big increase in mortgage delinquencies. Yes, mortgage payments are the first payments that most Canadians will make. It certainly, the arrears in mortgages are at historic lows, but depending on which bank data you're looking at, the numbers have edged slightly higher from about 0.11% last year to about 0.13 to 14% this year. That's still astonishingly low. So despite big increases in interest rates, rising unemployment from unemployment bottomed at 4.9% and rising to 5.8%. We still see that delinquency rates on mortgages are at historic lows. Now, the job market, this time in the Bank of Canada statement, was the first time that they admitted that labor markets have eased. The term they used is they've loosened. And by that, what they're suggesting is that the rise in the unemployment rate, the decline in job vacancy rates have boosted the effect of interest rates on labor markets. So we did see a surprisingly strong 25,000 new jobs in the most recent data for November. But again, that too is biased by the population growth. It used to be that if you got a 25,000 person increase in employment or 25,000 net new jobs, that would actually mean that the unemployment rate would fall. But now it basically takes a 50,000 net new job increase to stabilize the unemployment rate. So unemployment rates increased to 5.8%, up, as I suggested, from the 4.9% earlier in the cycle. But remember that prior to the pandemic, the unemployment rate was at 5.7. So though this is higher unemployment, it's still not considered to be recessionary level unemployment. And in addition, as I suggested, job vacancies, that's that dark black line there, have moved down sharply. So again, this is easing in the labor markets, which is exactly what the Bank of Canada wanted to see. One thing, however, that does disturb the Bank of Canada is the continued high level of wage inflation. Year over year wage inflation is at 4.8%, much higher than what the bank would like to see. And wage inflation could well follow through to higher prices, which means that inflation expectations become self-fulfilling. So again, here we've got another factor that the bank will be focusing on going forward. They would like to see these numbers come down. So here we go with the other concern, of course, is the headwinds facing the economy. Consumer debt is rising. It's not mortgage debt that's increasing, but it is other kinds of debt, be it lines of credit or auto loans, personal loans in general, and credit card debt. The credit card and auto loan delinquencies are up, as I mentioned. Monthly payments for adjustable rate mortgages and HELOCs have also risen sharply. Remember, those adjustable rate mortgages are the ones that are variable without a fixed payment. So those monthly payments rise every time the Bank of Canada tightened, which was every time the prime rate moved up. And we've also seen that 30-day mortgage delinquencies have edged a bit higher as well. So these are factors that have slowed the economy and likely will continue to see a slow economy. Now, what about inflation? Even last week, Tiff Macklem, governor of the Bank of Canada, commented that he believed that there was sufficient tightening in monetary policy to continue to push inflation downward. So that's the most direct I've ever heard him say that interest rates have peaked. And inflation, the headline inflation for the consumer price index has moved down to 3.1%. Now that was for the month of October. The next number for November will be released on December 19th. The month-to-month, year-ago comparisons get a little more difficult for December and January. In other words, year-ago levels in those months had very low inflation. So year-over-year inflation may be biased upward as a result of that. Now that's called a base effect. It's just a statistical anomaly, but nevertheless, it's something to keep in mind because the Bank of Canada is watching these factors very closely. Now, the headline inflation numbers were diminished by the fall in gasoline prices. Gasoline prices fell sharply in October. And in fact, very recently, for the month of December, gasoline prices have fallen sharply again. So that's good news. And it's also indicative of slowing global economic growth. In addition, the major components to inflation, the biggest contributors to inflation, are the food sector and the shelter sector. For food inflation, it has come down very sharply, but it is a large component of the overall CPI. It's one of the more visible components because most people grocery shop at least once a week. And so they see that prices are still high. Remember, lower inflation doesn't mean necessarily lower prices. And that's particularly true for products that don't trade in global markets. Gasoline does trade in global markets, and so those prices do come under downward pressure when the economy slows. But whereas we aren't seeing the huge markups in food prices any longer, still at 5.6%, but we also haven't seen big decreases in most food prices. So that's why the typical consumer doesn't feel as confident about reduced inflation as the data would suggest. In addition, you see that the core inflation number, CPI excluding food and energy, are at 2.7%, which is great news. But that's not the Bank of Canada's favorite measure of core inflation. The Bank of Canada looks at two other measures that try to take out the outliers. They take out the components of the CPI that are the most volatile. In that case, but in those cases, both the CPI trimmed mean and the CPI median are still in the 3.5% plus range, which is higher than what the Bank of Canada would like to see. And they mentioned in their press release that they are specifically focusing on their goal to see those core inflation numbers move down below 3%. Now, if you look at those measures, not on a year-over-year basis, but on a 3-month moving average basis, you can see here that they have in the more recent period, meaning over the last 3 months, they have come down to about 3%. Which in fact, it's slightly below 3%. This is great news for the Bank of Canada, and it is a primary reason why the Bank of Canada's press release this time was a more neutral press release than the very hawkish releases that we've seen over the course of this cycle. Now, for those who don't know, hawkish means tightening bias. Neutral means steady as we go, and a dovish bias, which is what I think we're going to see in coming months, means that we'll begin to see an easing in monetary policy coming closer. Now, today, of course, Bank of Canada held rates steady once again. As I mentioned, it was a less hawkish statement, and they're going to continue to normalize their balance sheets by letting maturing government bonds roll off. So this is exactly what was expected. And you see here that the overnight rate now is steady at 5%, has been at this level since late July. That, by the way, now is considered to be tight, and that is the way you measure that is the degree to which the overnight policy rate exceeds the inflation rate. So back in the earlier period of this cycle, the inflation rate was well above the overnight rate. And at that time, I said to you that the Bank of Canada's tightening would continue until the overnight rate was meaningfully above the inflation rate. And that is when policy is considered to be sufficiently tight. So we're at that stage now, both because interest rates have increased further, but more importantly, because inflation has fallen so much. As a result, we have seen a big rally in government bonds. Now, these are not yields that are determined by the Bank of Canada. These are market-driven yields. They peaked in October, and they have fallen almost a full percentage point since that time. So the last time the Bank of Canada met, the government bond yield, the 5-year yield, which is so closely linked to fixed mortgage rates, was at 4.28%. And it's currently at about 3.3%. As a result, we have seen lenders cut their fixed mortgage rates. However, they haven't cut them as much as what historically would be expected given a full percentage point decline in bond yields. In other words, the lenders are cautious in their taking rates down, and this is largely the result of tighter regulatory supervision. OSFI has increased the capital requirements on federally regulated financial institutions twice in the last 6 months. And most recently, they're targeting higher capital requirements on negatively amortized loans, which I'll get to in a minute. But just to compare where we are today to where we were in October when bond yields peaked, back at the October meeting of the Bank of Canada, the Monetary Policy Report said that CPI inflation would not return to 2% until the end of 2025. Nobody believes that anymore. Now, we have virtual unanimity in that it will be sooner than that. And I would suggest that we'll see headline inflation return to close to 2% sometime next year, 2024. So that's one reason, of course, why the Bank of Canada is now suggesting that their forecast would argue that interest rates have peaked, with the caveat that anything can happen, and if necessary, they will raise rates again. But I don't think it will be necessary, and nor do they think it will be necessary. Now, over this period, the prime rate is locked steady because the prime rate is determined by the overnight policy rate. And the prime rate is hugely important because the prime rate determines variable and adjustable mortgage rates. So it isn't until the Bank of Canada cuts overnight rates that we'll see the variable or adjustable mortgage rate decline. And it will be in lockstep with the easing in monetary policy. Now, if I had to guess, and I guess that's part of my job, I suggest that we will see the first cut in the overnight rate by the middle of next year. And with any luck at all, it could well be in April, May, or June. But of course, the world is a very uncertain and volatile place. And, nobody knows for sure, not even the Bank of Canada. As well, if I'm right that they start cutting rates by the middle of next year, I believe that we'll end next year with a 4% overnight rate. So that would be down a full percentage point, likely in 25 basis point increments. So that certainly would be a welcome change. It would take variable mortgage rates down a full percent as well. So the housing markets. The housing markets, of course, activity has been very depressed as a result of affordability issues, as a result of very high interest rates. Home sales declined for the fourth consecutive month in October. And then based on preliminary local data, home sales are pretty much flat in the month of November. We'll get the full report on that on the 15th of this month. But looks like sales were down a touch in the GTA, up a bit in the GBA, but we'll see when we get the final numbers. Clearly, activity is still quite slow. In addition, you can see that mortgage growth always declines when interest rates are high. So as rates climb, we see that the growth, this is an inverted scale, or I'm sorry, the scale here shows you that we've got 3.2% year over year increase in mortgage lending. And that, of course, is well below what we've seen historically. And looking back, we've seen much bigger numbers in previous cycles. As well, mortgage originations in Ontario fell more than 30% in the past year, just to look at this in more detail. So it has been a very weak 12 months, and I do believe that as we move through 2024, activity will begin to pick up. Now, one thing the Bank of Canada does not want to see is a rapid, large rise in housing activity, because they're concerned that that would just add to inflation pressure. However, the flip side of that coin is they understand that the large bulk of mortgages will be refinanced in coming years. Roughly 82% of mortgages outstanding will refinance by the end of 2026. And even with lower rates, they are likely to see monthly payments increase considerably. I believe that the overnight rate will bottom somewhere around 3%. That is considerably higher than the 1.75% we saw pre-COVID, and certainly well above the 0.25% we saw in the early part of 2021. In fact, throughout most of 2021. So those 2021 mortgages refinancing in 2026, most of them, that certainly means considerably higher monthly payments. And if the economy is slow and unemployment is high, this could be destabilizing. And the Bank of Canada has to take that into consideration as well. However, their mandate is simply inflation driven. So they will not ease until inflation, they believe, is hitting target or near target. And they're going to take it gradually because accelerating it might cause them to have to just tighten once again, which is certainly not what they intend to do. So new listings, of course, have come down. We've seen it's volatile. But right now, I would have to suggest that given the general expectation is for lower interest rates and a rebounding spring housing market, that a lot of potential sellers will be on the sidelines in the near term, waiting until that spring market to put their homes on the market. But certainly there is pent-up demand and pent-up supply. And the underlying fundamentals are still very strong for housing, again, because of that enormous increase in population growth. So market balance this is a buyer's market, certainly a buyer's market when you look at the country as a whole, and it varies, as it always does, from location to location. But it is far more favorable for buyers than it was over the past many years. And there is certainly a huge housing shortage. Now, home prices year over year are slightly positive. And that's just simply because a year ago, home prices are pretty much in line with where they are right now. They were just slightly below where they are right now. But as you can see from this chart, we did see considerable declines in home prices, although, of course, it did vary from region to region. Ontario has led the monthly decline in prices, and the prices have also softened in parts of BC. We've seen significant price gains in places like Calgary, so it does vary. Also, the major component of all this is housing affordability, which is why sales are so weak, because housing is unaffordable. It's in some places at historically bad affordability. So that has a lot to do with high interest rates, but also, of course, home prices. Now, what about mortgage originations and the decision between fixed versus variable? Well, if I'm right about interest rates coming down in the second half of next year, adjustable rate mortgages are now something that should be considered. And that is because, of course, an adjustable rate mortgage would adjust downward as the bank begins to remove its tightening in monetary policy. A neutral level of the overnight rate, which is considered to be the level at which inflation is at the 2% target, and there's no tightening or easing, that level is somewhere around 3% in my view. So if I'm right, You wouldn't want to necessarily lock in a 5-year fixed rate, because you would lock in today's high level of mortgage rates, even though those fixed rates have come down from their peak. But you certainly wouldn't want a variable fixed payment mortgage, because you're locking in a high payment, a very high payment, considering that the variable rates have not come down at all. So it's very interesting when you look at mortgage originations. Variable rate loan share was 8.3% in September. That's the latest data available from Stats Canada. It's down from a record high of 57% in July of 2020. So, of course, the flip side of that is that the originations have largely been in fixed mortgages, fixed rate mortgages, in that 3-year, in some cases 3 to 4 year maturity range. Now, this payment shock has gotten a lot of attention. It's the payment shock on renewal. Adjustable rate mortgage owners have already felt the full effect of higher interest rates, because their monthly payments adjusted with the overnight tightening by the Bank of Canada. 60% of Canadian mortgages will come up for renewal in the next 3 years. Actually, the latest numbers I've seen, as I mentioned earlier, was 82%. Now, that's based on the earnings reports of the big 6 banks. So who knows what exactly the number is, but it is a very large proportion. And OSFI has said that it believes that the fixed payment variable rate mortgages are this is their word, a dangerous product. 17% of all mortgages outstanding are these variable fixed mortgages, fixed payment mortgages. 12.4% of these have amortizations now longer than 35 years. OSFI wants these products to be less prevalent, but OSFI also does not typically get involved in product, the actual types of products that the lenders that they regulate would offer. But what they do is instead they discourage that product. So if rates fall by 100 basis points, mortgage payments will rise by more than 20% in 2024 and 2025. So this is like a lot of work has been done about this, regarding this, and this has gotten a huge amount of attention. It's guesswork, because none of us have the data to know precisely what these numbers would be, but also none of us know how quickly mortgage rates or overnight Bank of Canada rates will fall. And there's some caveats to some of the hysteria about this. There have been reports that this is tantamount to a major crisis. I would suggest it is not. Firstly, borrowers were stress tested with a 200 basis point cushion. Wages, as I've mentioned earlier, have risen considerably. Potential rate cuts lower the payments. Amortizations on refinanced mortgages could continue to be in excess of 25 years, especially for borrowers that can't afford the 25-year amortization. We've seen cutbacks already in consumer spending. The savings rate has increased, so households are well aware of this potential issue. And the biggest risk here would be rising unemployment, and particularly if we were to see substantial layoffs in a deep, long recession. Where we have seen layoffs, interestingly, is in the finance sector. Finance, real estate, all the banks are cutting their payrolls considerably, which makes sense given that they've all been subject to this reduced borrowing, particularly in the mortgage business, over the last several years. So in order to discourage these fixed payment variable rate mortgages, starting in 2024, next month, OSFI will increase capital requirements on negative amortization mortgage balances with loan to values above 65%. And this impacts all the banks, all the federally regulated institutions that offer these types of mortgages. So this is something that, this is the way OSFI does discourage what they consider to be a dangerous product. So I mentioned earlier that arrears at the banks are at historic lows. They have edged up for the Alt-A lenders. Bond yields have fallen so sharply, and normally when bond yields fall, it doesn't take long before you see a big increase in origination. So this is something that, as I have already said, is something that we're looking forward to. Gradual increases, hopefully next year, so we don't derail the easing in monetary policy. And then by the time we get to 2025, 2026, activity should be much stronger. Now, finally, we talk about the housing shortage every time the Bank of Canada meets. This housing shortage is extreme. And yes, there was an economic statement by the federal government. I frankly don't think it will amount to much. At the margin, sure, if you took more rental properties away from short-term leasing through Airbnb and put them on the market for longer-term leasing, that helps a bit, but it's all marginal, considering the kinds of numbers we're seeing in terms of increasing population. So Canadian population growth last year was 3.1%. It's by far the fastest among the advanced economies, not just the G7, but literally the whole OECD, rivaling the least developed nations kind of population growth. And we have seen, even with a new Minister of Immigration, they're sticking to that 500,000 target for planned permanent immigrants in 2025 and 2026. But these numbers are actually dwarfed by the influx of permanent residents. So this doesn't include foreign students, for example, many of whom become permanent residents. And it doesn't include the increase we've seen in foreign temporary workers, many of whom, in fact, become permanent. So this is just the tip of the iceberg in terms of what we're likely to see in terms of population growth. And as a result, the demand for housing will continue to be far, far in excess of the supply. And looking at this, That's why we've seen such a huge increase in the inflation rate in rents and rental accommodation. And 37% of Canadian households are renters. And I don't usually like charts that are just a wall of words, but frankly, these are new data available, and I really didn't want to throw in 10 more charts to go over this. So very quickly, annual rent inflation in October was 8.2%, which is the highest level in over 40 years, of course, caused by the unprecedented increase in working age population, up 874,000 over just the past year. And at the October pace, there is only one housing start per 4.2 people entering the working age population. This is compared to the historical ratio of one housing unit started for every 1.8 people, which is a 5 standard deviation difference from historical norms. There's no choice, therefore, but to bid up the price of this dwindling inventory of rental units. And then the current diversion between rental inflation and the overall CPI is at its highest level in over 60 years. So this just tells you how extraordinary this is and how untenable the situation is, because though housing starts increased a little bit in October, thanks to the elimination of the GST on new construction, it's a drop in the bucket compared to what we need to see. And we need 100,000 additional construction workers, most of whom will be temporary foreign workers hoping to become citizens. And as well, the surging cost of construction impedes the new home supply, both because it puts a lot of potential construction, multifamily construction projects on the back burner, because the borrower is unable to sign up, particularly those investor buyers that were such an important component of the pre-sale market in pre-construction market for condominiums. That market is dried up, both because of government discouragement of investors and also because of negative carry. In addition, municipal development fees are also surging, labor shortages everywhere, environmental concerns, the forest fires not only disrupted a lot of markets, but also reduced the lumber supply, on and on and on. And politicians talk about measures they're going to take, but nobody has really come to dealing with the root causes of this situation and what could be a solution to this situation. And it doesn't help that most cities in this country, big cities, have rent control. And if you look at some of these purpose-built rental apartment buildings around the GTA, for example, the average age of renters is far higher than the average age of the population, because if your rent is at 1990 levels, there's no way you're going to move until you die. So the supply in those markets is just not there. and the potential for building is diminished by potential rent controls. So it's a mess. Now, on the positive side of this, it means that housing investment and home purchases generally will continue to create equity, even though obviously housing affordability continues very high. So we've seen that construction investment has dwindled. This is all very much like a story that I tell really month after month, but I think it's important to keep it in mind because it is the basis for the unaffordable housing in this country.
Oh, Sherry, I have so many questions myself, but we have to get to. I think the first thing I just want to talk really quickly about is that whole renewal. You talked about up to 80+% in the next 3 years. There's borrowers out there. There's people with mortgages out there wondering what they should do. And my advice is call your mortgage professional and don't do it 60 days out, 90 days out. Do it now. So at least you have a head start in understanding what your options are. Really important to understand your options because the government, as you know, came up with some rule changes around insured mortgages, for example, where you don't need the stress test. And if you can shop that rate around and not have to be sort of stuck at your lender because you can't go shop, well, you need to know that. So there's a lot of different variables when it comes to those renewals. So please reach out to a mortgage broker at DLC, dominionlending.ca. Get in contact with them now. Have that discussion. Really important. I am so shocked that you actually said variable rate, only because I know you said in the past that, you know what, you're a very conservative person and you like to know your payment and you like to go to sleep at night, but you're saying that, you know what, variable rate can be an option. That's another discussion you should be having with your mortgage professional. It's so important to understand that fixed versus variable and where rates are going. So let's get to the questions first. If we have time, I have many more, but let's get to the questions. The first question is from Carlos Larma. Bad news means good news, ? Economy, not the best shape means good news for interest rates. And of course, that is true. And that's what they're driving towards, aren't they?
Yes, exactly. And that's why they call economics the dismal science, by the way.
Yeah.
But yes, exactly right. In order to get inflation down, you need to slow the economy. And they pretty much told us that interest rates have peaked. And when interest rates are at current levels, that's when you do want a variable loan.
There you go. Next question from our Jason Nugent, who's a popular one. If we have a significant increase in the unemployment rate, isn't that a much bigger worry since the population has grown so fast?
Well, it's easier to get a higher unemployment rate when there are more and more participants in the labor market. In other words, all these immigrants are coming into the country and they may not get a job right away. And so it biases upwards the potential unemployment rate because it takes more net new jobs per month to satisfy this increasing demand for jobs. Now, there's also labor shortages and increasing demands for workers. So it kind of balances out, but we have seen job vacancies decline over the course of this cycle. Now, what we don't want to see is the kind of unemployment that's caused by a real deep, long recession. And Canada hasn't had one of those in a very long time. We did not have that during the financial crisis in the US and the rest of the world. We haven't seen that since the early 90s.
Yeah. Okay, our next one is from Alessandro Luca. Hi, Sherry. Shouldn't a negative amortization be considered arrears? Delinquencies seem to be artificially low by letting borrowers not pay their full mortgage payment. I mean, Alejandro makes a good point.
Yeah, but it's not arrears in the sense that people aren't paying their monthly bill, because the monthly bill is fixed. But a lot of people did take the opportunity to make a lump sum payment,
Right,
to prevent the negative amortization. And that was an option that most of the banks did offer. And that certainly will make it more comfortable for those people when they have to refinance. But yeah, you're right. They're not paying as much as they would. And as a result, their mortgage payment ultimately could increase very sharply if they go back to the original amortization of 25 years.
Yeah, really interesting that OSFI's getting involved in that and forcing these banks to preserve more capital if they have that sort of product. That's very interesting. Okay, next question. I want to get through these as quick as I can. If houses are a shortage, does this make sense that clients are lowering their prices? Supply and demand.
Well, it's all about timing too. And just because your neighbor sold their property when interest rates were the overnight rate was at 25 basis points for 50% more than what you could get today, doesn't mean that that's really the value of your home. So obviously we saw a big increase in prices in 2021. And a lot of people look at comparables in their neighborhood. And if they're looking at the activity back then, they're not comparing apples to apples.
Yeah, and there's got to be a coming together between the sellers and the buyers, and they're just apart right now. So buyers are looking for cheaper houses, and sellers are looking for the utmost price. So they're not coming together. But once they do, which is going to happen, then you'll see that activity increase, and of course a much more buoyant housing market. Okay, next one is Oleg. Are we claiming victory over inflation, or are still caution is prudent?
Oh, caution for sure. For sure. I mean, that's what the bank says. It's, absolutely nothing's certain anymore. And particularly given all the global uncertainty, the geopolitical risk, and just basic human nature. Most people, that's why consumers don't really believe that inflation is slowed, because to them, inflation slowing means lower prices, and that's not what it means.
That's right. Yeah. Let's go with two more. Oleg again. Did I get it right? Job growth minus new workers equals not so great job growth.
Well, right. Like it takes more job growth to maintain a level of unemployment when you have more people in the labor force.
Yeah. Okay. So two more questions and then we'll wrap this up. From Deborah, we have, it seems that you have revised your estimate on how much the overnight rate will come down next year. Why?
I don't know that I did really. It depends on really what I wouldn't bet my bottom dollar on any of this, frankly. Yeah. I'm happy to say I don't know. I don't know. This is like an educated guess.
Yeah.
But I could change my view next week, let alone next Bank of Canada meeting.
Yeah, absolutely. And last question before we wrap up: has there been any impact on house pricing because of currency depreciation?
Not really. Nothing obvious. The Canadian dollar is going down. Our bond yields have rallied more than U.S. yields, which often does put some downward pressure on the Canadian dollar. A weakening Canadian dollar is inflationary because so much of our purchases are from the United States, so it costs more in Canadian dollars to buy U.S. product. But it's funny, at the margin, it's a small component because the Canadian dollar's been hanging out in the low 70 cents for quite a long time. Back in the day, when the Canadian dollar went from parity to 58 cents, it was a big factor. But at least in the past number of years, it hasn't been a huge factor.
Yeah, and another question popped up, and I would normally just pass it as a good one. As this year ends, how would Dr. Sherry Cooper rate the Bank of Canada in their fight against inflation? What do you give Mr. Macklem?
Well, he's done a good job. I mean, inflation's come down. That's the only measure that matters.
Yeah.
And let's face it, central banks blew it in 2021. They took rates down too far and left them there too long.
Yeah, and then Macklem went and said, hey, go spend money. It's not raising until 2023, and people did. And I think that's where he got a B-.
Exactly. And they talked about, that this was all temporary, but no.
Well, Sherry, another year has passed. I just wanted to say how grateful Sherry and I are that you all join us, every month during ICW. It means so much to us, right, Sherry? I mean, for us to share this content and for you to clarify and demystify. I love demystify, economic trends, and for this audience to resonate the way they did. We really appreciate every single one of you. So on behalf of Dave Teixeira, I'm not sure if you can show yourself, Dave, but he's our producer. He did a wonderful job all season. All the staff at DLC are incredible owners and brokers and agents right across the country. And of course, our sponsors. We want to wish everybody a safe and happy holidays, the best for 2024, no matter where you are in the country or in the world for that matter. Be grateful, be giving, but most importantly, be kind. So until next year, thanks everyone, and take care.